connect with Anand Krishnan, Head of Equity and Portfolio Manager with Franklin Temple Asset Management. Anand, good morning and thank you for joining us. Anand, what is your view on the earnings season so far? Because up until now, investors clearly have been handed over a mixed bag of earnings.
I think the kind of earnings that has been reported till now is fairly on dot. They have not been below expectation, and some companies have been able to deliver slightly better than expectation number. So Q3 of earnings seem to be at least pointing to some kind of improving or a bottoming out of margins for the corporate sector as a whole, and bottoming out of growth as well. We have not seen any incremental margin pressures develop during this quarter, going by the results that have come so far.
Anand, do you think the market is fairly priced at the index level at 13 to 14 times 1 year forward earnings? Where does the market go from here?
While in the near term, on the basis of near-term earnings, the market may look as if it is fairly priced. We do think that on a medium-term earnings basis, market is undervalued. The reason why we say that is the current margins of the entire corporate sector is fairly depressed. From a high 20-odd% of EBITDA margins, we have seen corporate sector margins come all the way to 13-14%. And given those low margins, where we see scope for expansion over a period of time, we think that earnings potential is pretty high. So based on where the earnings can go over a medium term, the market seems to be relatively undervalued at this point of time. On the basis of near-term earnings, it might look as if it is trading at 14 or 15 times earnings, which may look fair, but vis-a-vis its medium-term potential, and the ability to bounce back from the low margins, we do think that the markets are undervalued. Another reason why we think the markets are undervalued is there is a leverage in the corporate balance sheet at this point of time, and eventually this leverage will come down once the interest rates drop and the growth rates pick up. And at that time, the positives of the deleveraging cycle will accrue to the shareholders and eventually into the earnings growth. And that, I think, is a big cycle that is waiting to come under favorable circumstances, and that gives us the confidence that the markets are relatively undervalued at this point of time.
Right. Anand, a very overwhelming feature for the Indian mutual fund industry has been the kind of redemptions they are witnessing on a daily basis. So what's the update there? Have the redemption pressures eased?
We haven't seen big redemptions in our funds over the last couple of months. Nevertheless, we haven't seen any inflows either. Redemptions do happen in trickle because every time the market moves up, we have seen some investors take the money off the table. And at this point of time, it does look like the investors' investment sentiments towards equities doesn't seem to be pretty good. So we haven't seen inflows into our funds at this point of time. But nevertheless, the outflows seem to have moderated in the last couple of months.
All right, let's take a break. When we come back, we'll get you technical ideas from Ashwini at 8:30. Ranjan Devan, Executive Director of Bank of Baroda, will join us live with his take on credit policy. And then we'll also connect with Gaurav Kapoor, Senior Economist with RBS.
And of course, we'll get you domestic market views from Tirthankar Patnaik from Relicare. Also get you views from Vineet Bhatnagar from Phillip Capital. Basudev Banerjee will join in from Quant Broking. And we'll also speak to Tarun Kataria, independent analyst.
Welcome back. Unfortunately, we've not woken up to very cheerful headlines, but the good news here is that the emerging market currency contagion effect is not really the big story, at least for the world this Tuesday morning. Today, US markets, if I monitor the news flow, well, it's China and the slowdown in the US housing market, which clearly means that somewhere there is some hope that currency may just bottom out. That's the big underlying thought when it comes to the global cues. But let's go to Ashwini Gujral for some trading ideas. Ashwini, let's start with the first important levels on the Nifty, followed with your trading ideas.
Well, Nifty for the day needs to stay above 6151, resistance at 6172, 6209, support at 6114 and 6093. Bank Nifty must stay above 10,620 and CNX IT above 9951. VTST from yesterday, Allahabad Bank was a sell with a stop of 85, target of 72. Bank of India was a sell with a stop of 218, target of 203. And Hind Unilever was a buy with a stop of 558, target of 580. Now I have 3 buys and 3 sells, basically because I don't expect kind of a one-way slide today. So Torrent Pharma, which has been making higher lows, higher highs, even in this correction hasn't come down a whole lot. So that's a buy with a stop of 530, target of 575. ITC, which is making a base and coming out of that. Yesterday we saw positive action on levers also. So this is a buy with a stop of 319, target of 334. This is even a longer term buy because the stock seems to have bottomed out. Biocon, which has had tremendous selling from 490 almost down. Yesterday's low was about 400. So from there it had a sharp rally through the day. This is a buy with a stop of 410, target of 435. Tata Steel remains a sell. Metals are taking it on the chin, although banks seem to be mentioned a lot more, but metals have topped out. So the Tata Steel is a sell with a stop of 360, target of 345. Siemens, the cap good rally is probably now over. And all of these stocks are running to the downside. So this is a sell with a stop of 650, target of 625. And Axis Bank, which had a mild pullback rally and again started declining. This is a sell with a stop of 1180, target of 1125.
Mitesh, hi, morning. Well, amidst global sell-off, we too got trapped yesterday. What's the sense that you're getting about the market today? Do you think we will continue to trade with weakness?
Morning. I think, a couple of things. One is that we've broken 2 supports in a day. I think, one we gapped down yesterday, so we have a weekly negative gap down. And I think we broke 62, 20, 30 range and then 6150 as well. I think clearly with this lot of sectoral indices, which is the CNX IT, CNX Auto, CNX Banking, I think barring an IT, most of these stocks have given some kind of breakdown on the daily and weekly charts, and while on the CNX IT we've got only an intraday breakdown. My belief is that it does point out towards a strong possibility that the November lows of around 59.70, 59.90 should be retested. So I think in the next 1 to 3 days, I think possibly maybe 5 days, I think we might head towards sub 6,000 levels. And clearly with this breakdown, I think the market in the short term and the bigger part of the market, which is the breadth, I think looking negative. So the market in the short term has clearly become a market which I would want to sell on rallies.
Mitesh, if your view is that the November low of 5950, 5900 could be tested, why wait for the rally?
No, I think clearly, we've been having sell positions. I think on Friday we had strong sell calls on the realty stocks, all the 3 top realty stocks, which is HTL, DLF and India Wood Realty. I think if somebody wants to take a fresh position, I think, then the best case would be when you get these intraday pullbacks, which could possibly happen sometime today or tomorrow. If it doesn't happen, then you've missed out, unfortunately. But typically, I think, initiating something in the way middle of it, and then, being stopped out by intraday volatility may not be a good trading practice. So I think just as a trading discipline point of view, I think, if somebody wants to start afresh, I think wait for rallies, but otherwise carry on with the short positions.
Well, the one space which actually held out was definitely commodities. While equities and currencies gave up, it's the commodity space which acted as a safe haven. So let's bring on board Manisha then to talk about all the cues this morning. Manisha?
Thank you for that, Aisha. Well, the commodity space also has seen some profit taking coming in the New York session yesterday. The Asian markets, though, have seen some buying come back right now. It really is 2 or 3 factors which are weighing on all asset classes, including commodities as well. One, you have the Chinese slowdown, and you also have seen the current account deficit widen up for most of the emerging market currencies. And the major one, of course, is the Fed expectation that it may reduce stimulus further this week, and that has taken the gold prices as well down with that. We did see 1280 in the markets yesterday, which was a 10-week highs, but it's just about holding 1260 in the Asian markets at this point in time. So considerable decline coming in for gold and silver as well in last 24 hours. There also is a report out from Society General, and they have put average price for gold at $1135 in 2014 and even lower at $1,100 an ounce in 2015. So next couple of years expected to be bearish as per most brokerage houses in the precious metal space. The energy prices also are off their highs. We did see NYMEX at 3-week highs in the markets yesterday. It has come down from those 97 kind of levels to around $95 per barrel right now. The crude prices had gained 2.5% in the previous week, but the markets are expecting the US weekly inventories to see a rise, and that is putting pressure. Not just crude, if you look at the natural gas prices, those declined 6.5% in the markets yesterday, and they are trading off their 4-year highs as well. And the decline continues for the base metal space. After falling more than 2% in the previous week, you have seen copper prices decline quite sharply. They definitely are trading off their 7-week. They are trading at around 7-week lows at this point in time. It really has to do with the worries in China that is putting very strong pressure onto that space. How do you trade all of those commodities? For that, let's get in cues from Ashok Mittal.
Indian market, I think 30,000 should be sold with a stop loss of 200 or 300 rupees, and the downside we can expect 29,500. In Indian market, close to 46,000 rupees, 45,800 to 46,000 rupees should be sold, stop loss 1,000 rupees and target of 2,000 and more or in say 1 or 2 trading sessions. And Indian market, I think 6,100 is a good support which can be bought, and on the $2 miss we will get around 120 to 150 rupees.
Stocks news, and for that let's go to Yatin. Morning, Yatin.
Good morning, Nikunj. Well, the first stock you need to watch out for will be NMDC from the metals and mining space, and the board will mull the interim dividend on February 10th. Of course, the market has been speculating given the cash on NMDC's balance sheet, which is to the tune of 22,000 crores. So markets are expecting a hefty dividend, something like they expected in Coal India. So, 8 to 10 rupees is the kind of expectation the market is building in currently for NMDC. So let's see how the stock really reacts after there is a board meeting scheduled. Eros, from the media and entertainment space is surely that you need to watch out for, and we have a lot of movies which have been doing a good business on the box office, and this time it's Jai Ho, which is a Salman Khan starrer, and they have grossed close to 101 crores in the first week of opening, and possibly there would be some sentimental positive rub-off on Eros as per the media analyst. From the result season, we have Just Dial as well as Welspun India. Just Dial clearly disappointing on the operating front. We have the revenues that were up sequentially 6.4%. However, we had the EBITDA which was down 5.4% on a quarter-on-quarter basis for Just Dial. And profits also coming under pressure because of the compression in the margins. So profits came in at 30 crores, almost up by nearly 4% on a quarter-on-quarter basis, but slightly below what the analyst community was expecting. So let's see how the stock reacts here to numbers. And finally, Welspun India, strong set of earnings. They have been surely gaining from the weak currency as well as the export story. So sales came in at a little over 1,000 crores, and profits saw a growth of 43% on a year-on-year basis, which came in at a smart 109 crores. So let's see how all of these stock react in trade today.
Okay, Yatin, many thanks for the detailed analysis and all the stocks which are going to be in the news. But Anand Radhakrishnan from Franklin Templeton Asset Management is still with us. Anand, thanks for patiently waiting by. What's your market view, predicated on what kind of GDP growth and earnings growth will underline the direction of the market according to you?
If you really look at the market's earnings growth over the last 10 years, first 6 years we have had earnings growth in excess of 20-odd%, and we have seen less than 8% earnings growth in the last 4 years. I'm talking about compounded annual growth rate of 8%. So we have seen a phase of high earnings growth and then the phase of a very modest earnings growth. Now the question one needs to ask is, do the next 4 years, what are the likelihood that the market corporate earnings growth will be more like 8% or less than that, or is it going to be more like 13, 14, 15%, or can it be even 20% for that matter? Now we think that earnings go through a cycle, and currently we have gone through a a very, very modest cycle of 8% earnings CAGR over last 4 years, and this will reverse over the next 3-4 years, and we would see next 3-4 years earnings growth of upwards of 13-14%, which augurs well for the overall market as a whole. So that's the reason why we do tend to be a little more optimistic about the direction of the market, despite all the macro headwinds which we seem to be having at this point of time, as well as the global uncertainties that keep coming up every now and then. It is based on corporate earnings growth, and corporate earnings does seem to have bottomed out, and it is looking to grow at a more nominal pace in the next 3-4 years.
Anand, we ask a lot of FIs that how do they tie in the political risk with the India strategy, and we've asked Dr. Mark Mobius this in the past as well. As domestic investor, what macro political risk are you navigating while managing your portfolios?
No, as a domestic long-only portfolio, I don't have the luxury of timing the market or deciding whether I like or do not like the market. We tend to understand the macro risk, but we don't try to take excessive view of it and try to factor it into the portfolios. Our portfolios are built on from a bottom-up basis. So the whole idea is to kind of identify companies, good quality, long-term winners which can compound your money at a consistent pace. And as long as these managements are able to traverse the macroeconomic environment, the political environment very well, we as investors are fairly safe. So the main job as portfolio managers which we do is to try to find companies, managements which are able to navigate the environment of a country, economic environment and the political environment of a country very well. We ourselves do not traverse that environment at our end. We let the companies where we invest in do that job for us.
So Anand, what happens to infrastructure, power, capital goods, metal story over the next 6 months? And when does allocation of money shift to those sectors in a meaningful manner rather than just to see, trading rallies trickling in?
We might see a revival in the infrastructure capital goods sector, definitely, for sure, because we do need a large infrastructure still to come online. But our view is a little more nuanced here. We think that our historic investments which the companies have made either on themselves or in a public-private partnership model, many of these investments are either yet to kind of fructify in terms of returns, or some of those projects are yet to get commissioned. So many of the corporates which are already made the investments are waiting to make money out of those investments, and so are the investors. So unless it is proven that the existing investments in the infrastructure space is yielding returns to the investors, it's very unfair to expect them to make further more investments in that space. Neither do they have large internal accruals to commit to investing more in the infrastructure space. So that is a problem which we have, and therefore we would like to see the fructification of the current infrastructure investments as a first step towards building a slightly more constructive view. Till the time we see momentum being built along those lines, we would like to maintain a cautious stance to that sector.
What is your expectations from RBI, because you have a reasonable exposure to banks? Would a rate cut now from Reserve Bank of India could cheer the banking sector, which otherwise is not in a great shape, so to speak?
On a lighter note, we have been waiting for inflation to come off for more than a year or so now, and it seemed to be a very elusive thing to chase, given the stickiness of inflation and how deeply embedded the inflationary expectations are. And also, given the recent turmoil in the emerging markets and the wobbling which we are seeing in the global markets, we would expect the central bank to take a cautious stance and would not like to take any aggressive step towards easing interest rates at this point of time. So I wouldn't be surprised if they hike the rates, which seem to be the consensus at this point of time. but this should not be this should not be viewed as a structurally negative stance. These are, given the current circumstance of high inflation and the macroeconomic instability that we are seeing across emerging markets, it would be prudent to take a more conservative stance at this point of time.
Anand, good chatting with you. Really appreciate you taking the time out and speaking with us today. That's the view coming in from Franklin Templeton. Let's just revisit what the SGX Nifty then is up to. 27 points lower as we speak, so it doesn't seem like we're quite done with all the weakness. And today it seems like we're going to